What's up, YouTube? It's the Money Man here, and we're talking about market indicators, specifically today the yield curve and the inverted yield curve, and what they really mean. So the concept. So this chart graphs the yield that you get from Treasury notes, bonds, and bills all along a timeline. So like the 3-month Treasury bill versus the 10-year Treasury bond. And the shape of that curve is what we use to either predict the current state of the market or the current trend of the market and where inside the business cycle the US economy is in. A normal yield curve goes from a very small return because it's over a very short period of time, such as 3 months, and extenuates upward and outwards. As the time increases, the yield will also increase. At least that's in a normal situation. However, there are times where the yield curve inverts. And what we mean by that is that the return on the 3-year bill is higher than the return on a 10-year or 30-year bond. What this really means, it's a very strong indicator that the market does not have faith in the long-term returns of the US government anymore. They have the faith that they will get repaid, but that it won't have the same return as a short-term bill will. What this is really indicating is a weakness and the start of a US recession. And it's used to predict the US recession because of that. A recession is when there's 2 consecutive quarters of GDP decline. At least it's the easiest way to tell that the US is in a recession. There are other indicators and other ways in which economists use to determine whether or not we're inside a recession. But this is the easiest one for everyone to see and understand. The last 2 recessions inside the US were predicted by the yield curve in both the 2000 and in 2006, prior to the recession that started in 2008. It really is crazy how strong a predictor this is. The reason why we would care about the start of a recession as an active investor is because stock market crashes generally predict or precede recessions, especially inside the US. And this was 100% true for 2001 and 2008. It's hard to tell if this indicator will work for predicting the next US recession. The Federal Reserve has never held rates as low for as long until now. There will be more videos in this series coming soon, more market indicators and more ways to potentially tell if a stock market crash is on the way. Thanks for watching my video, guys. I hope that this video helped you understand the US yield curve a little bit better and the inverted yield curve and what it really means and what it can do to help predict coming recessions and potentially stock market crashes. Please let me know, like, comment on the video, subscribe, all that fun stuff.